This is Chapter 2, Part 1 of a three-part presentation. As I said in the syllabus, this is one of the most important chapters in order for you to understand accounting. So you really have to pay attention to Chapters 2 and 3 because they're the ground rules for everything else you do in the rest of the semester. So what I'm going to cover in this section is the accounting formula and debits and credits. Now, what we're going to do in this first part is we're going to explain what's a transaction, what's an account, types of accounts, and the debit-credit process. Then, in Part 2, we're going to cover double entry accounting and recording financial transactions. And then in Part 3, we're going to cover the trial balance and a few examples of similar to your homework. Now, first of all, let's remember the accounting formula because accounting is all about understanding the accounting formula and what those definitions mean, i.e., what is an asset? It has to have future economic value to the company. An example is cash, because if you have cash, you can buy things in the future. Liabilities, what do you owe to creditors? And stockholders' equity, which are investors' claims. So, what you have to also remember is stockholders' equity includes common stock plus retained earnings, which includes revenue minus expenses, which is net income, and dividends. Remember, dividends are never an expense. So, remember that revenues increase retained earnings and expenses and dividends decrease it. Now, accounts, a record of all transactions related to a particular item over a period of time. Asset accounts, examples would be cash, supplies, equipment, accounts receivable, any prepaids where you pay in advance like insurance. Liabilities, we would have accounts payable, salaries payable, utilities payable, taxes payable, notes payable. These would all be examples that would fall under that category. Remember, assets and liabilities are categories. Stockholders' equity is a category. Now, what would be included in stockholders' equity? Two examples would be common stock and retained earnings, but also dividends. Now, a chart of account is a list of all the account names used to record transactions for your company. Every company has a different chart of accounts, depending on the count of transactions that they have. Now remember, we're always looking at a financial transaction that's directly related to the company. So, whenever there's a financial transaction, it'll have a dual effect on the accounting equation. If total assets increase, then liabilities or stockholders' equity also must increase for the same amount. If total assets decrease, then liabilities or stockholders' equity decreases by the same amount. Now in accounting, we do what's called double entry accounting. There are always two parts, a minimum of two parts. Giving and taking is one way of looking at it. Accounting based is on a double entry system. Each transaction affects at least two accounts. Remember, it can affect more than two accounts, but normally it's just two accounts. The accounting equation always balances before and after every transaction. Understanding the effects of a transaction. First of all, you'll want to know, whenever something happens, what account is affected. Does this account increase or decrease? Next, what's the second account affected by the transaction? Does it go up or down? And then third, do assets equal liabilities plus stockholders' equity after the transaction? They must every time. Now let's look at a tool that's often used by accounting. It's what we call the T account. And what it does is it helps visualize when you're working through a problem. I use T accounts all the time still, even though I've been doing accounting. I can't even tell you how long I've been doing accounting, but it's a long time. So you have an account title, and on the left is the debits, and on the right is the credits. Every transaction has both a debit and a credit, but not to the same account. Okay, to separate accounts. So one account may have a debit, the other account must have a credit. Now, what are the rules of debits and credits? Well, the rules are debits and credits are neutral terms. That means they do not mean increase, decrease. Not at all. They are neutral terms. Not good or bad, means either a decrease or increase depending on the type of account. So now let's take a look at accounts and how they're affected. So we have assets equals liabilities plus equity. Now remember, these are not accounts, these are categories. But in general, assets we increase with a debit, we decrease with a credit. Liabilities we decrease with a debit, and we increase with a credit. Stockholders' equity we decrease with a debit, and we increase with a credit. Now that's not true for some of the individual accounts in stockholders' equity if they decrease stockholders' equity like dividends and expenses, but we'll cover that. Now, another thing you got to remember is not only debits and credits are neutral, left side, right side, but what are the normal balances? The normal balance is what increases the account. If the balance is not normal, it indicates a negative amount. Now, this is one of the things you're always looking for at the end of the month. When you look at all your account balances, the first thing you're going to look is to see, do they have their normal balance? And now we're going to go through an example, and I'm going to show you what the normal balances are depending on where the accounts are on the accounting formula. So here we have assets equals liabilities plus stockholders' equity, which is broken down between common stock, retained earnings, revenue, dividends, and expenses. So we're going to start with assets. We decrease with a credit. The normal balance is a debit. So remember that. Assets, the normal balance is always a debit. If it's not a debit, you need to go back and look at what you did. Liabilities, you decrease with a debit. The normal balance is always a credit. Now, common stock, which increases stockholders' equity, you decrease with a debit, and you increase with a credit, and therefore that's the normal balance. Retained earnings, you decrease with a debit, increase with a credit, that's the normal balance. Revenue, decrease with a debit, we increase with a credit. Now, we have dividends and expenses which reduce stockholders' equity, so they have the opposite relationship. For dividends, we decrease with a credit, and the normal balance is a debit, and that is the same for expenses. The normal balance is a debit. Now, here's something to remember. If an asset, going back to assets, if you end up with a credit balance, something's wrong. Okay? If you have liabilities and you end up with a debit balance, something is wrong. It can't be right. Okay? Common stock, it can never have a debit balance. Returned earnings can have a debit balance if you have sustained years of losses. So, and that's called a deficit. So retained earnings is one of those that can go either way. Revenue can never have a debit balance. Dividends can never have a credit balance. In order for it to have a credit balance, people would have had to give you back the money that you paid them out, and that's not going to happen. Expenses cannot have a credit balance. So, that's the reason you need to know normal balances, because it should immediately alert you, I've done something wrong. So, knowing the normal balances of accounts is important, because if an account does not have a normal balance, it is a sign that something's wrong or you need to reclassify an account. A good example would be accounts receivable, which means people owe you money. If you end up with a credit balance in an account, what that means is someone has overpaid you, which means now it would become a liability. Debits and credits. You debit to increase assets, dividends, and expenses. And you should just write that down. Credit to increase liabilities, revenue, common stock, and retained earnings. So, do not proceed until you know these rules. You got to remember that, because that's going to help you with part 2 when we're actually doing journal entries. Now let's go through a little example to end this part. All right, supplies. It is an asset because it has future economic value, and we increase it therefore with a debit. Notes receivable means somebody owes us money and they've signed a note. That is also an asset, which means you increase it with a debit. Fees earned, which is the same as service revenue, is revenue or stockholders' equity, and we increase that with a credit. Dividends is also equity, but that we increase with a debit because dividends reduce equity. Accounts payable is a liability. We increase with a credit. Salaries expense is also part of equity, and we increase it with a debit because it decreases stockholders' equity. Capital stock is equity, credit. Accounts receivable is an asset. Therefore, its normal balance is going to be what? A debit, and that's how we increase it. Equipment is an asset, therefore a debit. And last, we have notes payable, which is a liability, which means we have to use a credit. So that's an example to walk through. Hope that helped you. And that ends part 1.